Is MPLX a buy or a sell? Let's get started with the model. This is a large cap company, 48 billion market cap. They're trading at $47 a share, and they have 1 billion shares outstanding. MPLX is a midstream company. They're involved in the gathering, processing, and transportation of natural gas. They also have vessels to transport crude oil, renewable fuels, chemicals, and feedstock. They also have facilities for storing and blending refined petroleum products that they deliver through pipeline, rail, and vessel. They are a subsidiary of Marathon Petroleum. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow goes up a little bit from 4.4 billion to 4.7 billion. That's not even beating inflation, but still a pretty good number, 4.4 billion, so they're maintaining it. Amazing margins. They convert 44% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. That goes up nicely from 2.9 billion to 4.3 billion. Revenue is a sales for the company, and that goes up a little from 9.6 billion to 10.7 billion. Not much growth since 2022. Pretty much flat since then. They pay an amazing dividend, 8.6%, which cost them $4.1 billion, which they can cover 1.1 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows, past year 4, that's 72 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $64 billion. We divide that by 1 billion shares. And we get a calculated stock price of $62.50. They're trading at 47, so they're trading at a 25% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 45 companies in the same industry as MPLX, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $1 billion in CapEx, but a lot of these companies are spending $3, $4, $5 billion. Midstream companies need to spend a lot on CapEx just to maintain their infrastructure. They have pipelines, they have terminals, etc. This industry has a pretty high debt-to-equity ratio. They're at 1.6, so for every dollar of equity, they have $1.60 of debt. DT Midstream is the best at 0.6. Their headquarters are Detroit, Michigan, so DT for Detroit, M for Michigan. This industry pays a great dividend. They're on the high side at 8.6. Frontline is leading the way at 10.1%. They generate a lot of free cash flow, 4.7 billion. ET is number 1. I'm up about 120% on that stock. They rank 7th in market cap. Enbridge, the Canadian midstream company, is number 1 at 89 billion. Price to book is 3.5. That's stock price over book value per share. PE looks good. It's better than the median average at 11.1. Frontline is the best at 7.1. I wonder why Frontline looks so undervalued. Price to free cash flow is pretty close to median, 10.1. Plains GP Holdings is number 1 at 2.9. Price to sales is 4.5. The way you calculate price to sales, it's market cap over revenue. They're trading at 4.5 times revenue. They generate 10 billion of revenue. ET is number 1 at 83 billion, and their 5-year annual revenue growth rate is 6%, equal to the median. If you put $10,000 into this company 10 years ago and reinvested the dividends, at one point in April 2020, you would have been at $3,000, and you would have probably been cursing this stock. But if you held on, you'd be at $16,000 today, a 55% return. To summarize, I have them trading at a 25% discount. I really like this company, ranking 8 out of 10. Would I buy it? Definitely would buy it, 8 out of 10. Ratios look good, a little better than average, so I give them 7 out of 10. Financial is 5 out of 10 because they're not really growing that much anymore. It's kind of flat. They're probably growing with inflation, maybe a little less. Let's take a look at their 10Q. They just released it this week. We'll start with their income statement. This is the third quarter of 24, third quarter of 23. Revenue is almost identical, 2.9 billion to 2.97 billion. They give a pretty comprehensive breakdown of their revenue. Service revenue 700 million plus 1.1 billion, so about 1.8 billion of service revenue. Rental income is 63 million plus 216 million, 279 million. Product sales 433 plus 51, so 484. Nice palindrome. Sales type lease revenue 118 plus 34, and their income from investing in other companies 149 million. Below revenue are their expenses. Cost of revenue, $400 million. That's all the cost to deliver the product to the customer. They also have to buy the commodity, the fuel. The cost of the products is $400 million. Of course, a lot of depreciation. They have lots of fixed assets on their balance sheet. So total expenses, $1.7 billion. Revenue minus expenses equals operating income, $1.3 billion, up from $1.15 billion. They pay interest on their debt, $226 million. So net income, a little over $1 billion. They are adding shares. They added 19 million shares. Last year, a little over $1 billion. Now it's $1 billion and 20 million. Let's look at their balance sheet. Assets, $38.5 billion. Their biggest asset, of course, is PP&E, property, plant, and equipment, $19 billion. They break down the PP&E into the two segments, logistics and storage, $8.6 billion, gathering and processing, $10.5 billion. So that total is $19.2 billion. The gross value, what they paid for the fixed asset, was $28 billion. They depreciated $9 billion. They also have a lot of goodwill, $7.6 billion of goodwill. Goodwill is the premium you pay when you acquire another company. They had a big acquisition in 2015 when they acquired Mark West Energy for $20 billion. This acquisition really put MPLX on the map. At the time, they became the fourth largest MLP. A little info about Mark West. It was founded in 1988. They do natural gas gathering, processing, and transportation. They're also a MLP, Master Limited Partnership. I did a video once on MLPs. If you want to learn more about it, click on the top right corner. The video is popping up. An MLP is a publicly traded entity that's taxed as a partnership. So it combines the benefit of a partnership with the liquidity of being a public company. When you become a publicly traded company, you become very liquid. Anybody can buy or sell the company. But to become an MLP, at least 90% of the company's income has to come from natural resources, like what this company does. Or it could be in real estate. So their total assets, $38.5 billion, up $2 billion from last year. Liabilities, $25 billion. They have a lot of debt, $19 billion of debt. Most of the debt is fixed rate senior notes, $22 billion. And if we scroll down a little bit, it talks about those notes. The debt matures between 2024 and 2058. Interest rate 1.75 up to 5.65%. And the notes pay interest on a semi-annual basis. And they mention Mark West right here. It looks like they issued $1 million of notes for the acquisition. And that has an interest rate of 4.875%. Assets minus liabilities equals equity. They have $14 billion of equity. $9.4 billion of their equity is common stock to people like me and you. $4.2 billion of their company is owned by Marathon. I'll show you Simply Wall Street later, where Marathon is the biggest shareholder. If you look on Marathon's Wikipedia page, it talks about MPLX. MPC owns the general partner and majority of MPLX, a midstream company which owns and operates gathering, processing, and fractionation assets. Fractionation is a separation process. They boil the liquid and certain hydrocarbons are removed. Let's take a look at a statement of cash flows. The first section is operating cash flow. Operating cash flow is net income converted to cash. So you take net income, then you add back the non-cash items on the income statement. So even though they reported a profit of $3.2 billion, they actually generated $4.3 billion of cash flow. But they spent a lot on CapEx, $748 million. That's the investment in property, plant, and equipment. They also spent $622 million in acquisitions. It looks like their big acquisition for this quarter was Utica Midstream. So in the first quarter of this year, they used $625 million to purchase additional ownership in Utica Midstream. They report this investment as equity method accounting. They don't consolidate the numbers onto theirs. So you can see it's right here on the statement of cash flows, income from equity method investments. It's negative because they reported a gain on their income statement. They have to reverse out in the statement of cash flows. It was a non-cash gain. But they did receive $600 million of dividends from those investments. So that is a cash item, so they added here. In their financing section, they added $1.6 billion of debt. It looks like they needed that debt because they paid $2.6 billion of dividends. Last year, $2.3 billion. Let's take a look at a stock on Simply Wall Street. Its last price, $47 billion market cap, up 6% in the past week, up 33% in the past year. Here's a stock price since 2012. It looks like it went from 27 to 82. And this is when they were acquired by Marathon. So the stock went from 82 down to 18. It went up slightly over the next 2 years or so, and then it really came down in March and April of 2020, its lowest point ever, $10. But imagine picking it up below $10, you'd be killing it right now, because the stock is getting close to 50, and it's paying an 8% dividend. That's 8% on this cost basis on $46 a share. You'd be getting the same dividend, but your cost basis will be below $10. So for one share, the total dividend paid for the past 12 months is $3.40. So if your cost basis is $10, your yield would be like 35%. That's quite a hefty return. Simply Wall Street stock price is 93. They say the stock is 50% undervalued. 16 analysts priced this stock at 48. So they say it's slightly undervalued. Their dividend back in 2015 was only 2%. It got real high in 2020, 17.5%. That's because the stock price came down so much. The forecast for 2026 is almost 9%. If a company pays a consistent 9% dividend, everybody would buy the stock, and that means the stock price will go way up and then push a yield down. It looks like there's no insider trading the past year. Public companies own 63% of the stock, institutions 24%, general public 13%. The biggest shareholder, as you know, is Marathon Petroleum. They own 63% of the company. Alps is also located in Colorado. They have ETFs and mutual funds. Harvest Fund Advisors, they're part of Blackstone, 2.25%. Goldman is 1%. Kanye West Investments, 0.5%. Miller Howard is a boutique investment firm in upstate New York, and the ticker trades on the New York Stock Exchange. So if you want to learn about MLPs, click on the video in the top right corner. Thanks for watching.